The average person will earn $2.5 million in their lifetime, yet 95% will reach retirement with almost nothing. Not a little, almost nothing. The difference between wealthy and broke is not how much you earn, it is not where you grew up, it is not luck. It is 5 specific financial decisions, decisions that most people never make because nobody ever explained them clearly. Until now. Today we are breaking down the 5 wealth building moves that actually separate the top 5% from everyone else. These are not theories from a textbook. These are specific, actionable moves you can start this week with the money you already have sitting in accounts right now. We are counting down from number 5 to the single most powerful strategy on this list, the one that compounds into real generational wealth over time. Stay until number 1 because it is the strategy that financial advisors rarely talk about in public, but every wealthy person you know is quietly doing behind the scenes. Let us get into it. Strategy number 5, the high yield savings arbitrage. Here is something that should make you angry. Right now in 2026, traditional banks in almost every country are paying you between 0 and 0.1% interest on your everyday savings account. At the same time, those exact same banks are lending your money to other customers at 6%, 7%, even 8% interest. They are making thousands of dollars per year using your money and paying you almost nothing for the privilege. Here is the move. In 2026, high-yield savings accounts are offering between 4.5% and 5.5% per year. That is 50 times more than what the big traditional banks are paying you. And switching takes about 10 minutes online. Let me give you specific numbers by country so you know exactly where to go. In Australia, ING Savings Maximizer is offering up to 5.5% per year. With conditions, UBank is offering up to 5.6% as an introductory rate, and Macquarie Bank is paying 4.75% per year with absolutely no conditions at all. You just deposit your money and earn. In the United States, Marcus by Goldman Sachs and Ally Bank are both offering around 4.5% to 4.8%. In the United Kingdom, Chase and Monzo are offering around 5%. The principle is identical in every country. Stop leaving your emergency fund in a legacy bank that pays you nothing. Now let me show you what this actually means in real dollars. Take $25,000 sitting in a traditional bank at 0.01% interest. You earn 2.50 cents per year, $2.50, on $25,000. Now move that same $25,000 to a high yield account at 5%. You earn $12.50 per year. That is $12.47 in extra income from money you already have, without doing anything differently except where you park it. Over 5 years, that is 60 cents 235 in extra money, just sitting there, growing, while you sleep. This is the foundation of everything else on this list. Your emergency fund, your short-term savings, any cash buffer you hold, all of it should be in a high-yield account earning as close to 5% as possible. This week, not next month, this week. It takes 10 minutes. Strategy number 4, the dividend reinvestment strategy. And this one surprises most people when they see the actual numbers. Most people who invest in dividend-paying stocks do one thing with their dividend payments. They take the cash. The dividend hits their account. They see a nice little deposit and they spend it or leave it sitting there doing nothing. That single habit is one of the most expensive financial mistakes a long-term investor can make. Here's the comparison, and I want you to really sit with these numbers. $50,000 invested in dividend-paying stocks at a 4% annual yield. If you take those dividends as cash every single quarter, you receive $2,000 per year. Over 20 years, assuming modest stock price growth of 5% annually, your portfolio grows to roughly $132,000. Nice! You also received $40,000 in cash dividends along the way. But here is what happens if you enable automatic dividend reinvestment instead. Every dividend payment automatically buys more shares. Those new shares generate more dividends, which buy more shares, which generate more dividends. It is a compounding loop that accelerates over time. After the same 20 years with the same starting $50,000 and the same 4% dividend yield, you do not have $132,000. You have over $220,000. That is $88,000 more wealth from the exact same starting investment, zero extra money contributed. Just changing one setting in your brokerage account. The portfolio structure that works best in 2026. Put 70% of your investments into dividend aristocrats, companies that have raised their dividend every single year for 25 consecutive years or more. These companies have survived recessions, market crashes, pandemics, and financial crises, and still paid you more each year. Globally, that includes Johnson & Johnson, Procter & Gamble, Coca-Cola, and 3M. If you are investing on the Australian Stock Exchange, look at Commonwealth Bank, BHP, Wesfarmers, and Woolworths. Put 20% into broad dividend ETFs for instant diversification across hundreds of companies. In the United States, that means VYM or SCHD. In Australia, that means VAS or A200. Globally accessible options include VHYL from Vanguard. Put the remaining 10% into REITs, real estate investment trusts, for property exposure and income without ever being a landlord. Enable automatic dividend reinvestment on every single position in your portfolio. Log into your brokerage account after this video and turn it on. Then check it once per year. That is it. The compound effect from 2026 to 2046 on a $50,000 starting portfolio is genuinely extraordinary. And here is a bonus specifically for Australian investors. Australian dividend stocks often come fully franked. What this means is that the company has already paid 30% corporate tax on your behalf before sending you your dividend. You receive a tax credit for that amount, called a franking credit, which you can use to reduce your personal income tax bill. No other country in the world operates this system. It makes Australian dividend investing uniquely powerful because your effective dividend yield is often 30 to 40% higher than the headline number suggests once you factor in the franking credit benefit. Strategy number 3, maximizing your tax advantage retirement account. This is the strategy most people are getting dramatically wrong. Not because they are doing the wrong things, but because they are doing too little of the right thing. They set their contribution at the minimum required by their employer and never think about it again. And that single act of inertia costs them hundreds of thousands of dollars over a working lifetime. Every major country has a version of a tax advantage retirement account. In Australia, it is called superannuation, and you can make voluntary salary sacrifice contributions on top of your employer's compulsory 11.5% contribution. In the United States, it is the 401k and the IRA. In the United Kingdom, it is the pension scheme. In Canada, it is the RRSP. The principle is exactly the same in every country. You contribute money before it gets taxed at your marginal income tax rate. Inside the account, it grows either tax-free or tax-deferred. And you get an immediate guaranteed return that has nothing to do with market performance. Here is the specific maths on why this matters so much. You earn $85,000 per year. On income above roughly $45,000, your marginal tax rate in most jurisdictions is around 34%, but contributions into your retirement account are taxed at only 15% at the point of contribution. That gap, 34% minus 15%, is a guaranteed, risk-free, immediate 19% return on every single dollar you contribute above the minimum, before that money even gets invested, before the market does anything at all. Now let me show you what a small change actually produces over time. Add just $200 per fortnight in extra voluntary contributions. Because of the tax saving, your take-home pay only drops by about $130. You feel $130 less in your pocket, but $200 goes into your retirement account, working for you from day one. You are effectively investing $200, but only sacrificing $130 in lifestyle. Over 25 years at a conservative 7% annual return, that extra $200 per fortnight becomes $291,000. From contributions that felt like $130. That is the power of combining compound growth with a built-in tax advantage. Log into your retirement account right now. Check your current voluntary contribution rate. If it is at zero or at the minimum, increase it by just $50 per fortnight this month. Just $50. Then increase it by another $50 in 3 months when you barely notice the first increase. Strategy number 2, the equity multiplier. This is where wealth genuinely accelerates, and it is available to anyone who already owns property and has built meaningful equity over time. If you own your home, you may be sitting on a significant asset that a bank will lend against at rates far lower than any investment loan or personal finance product. A line of credit secured against your property can be drawn down and invested into income-producing assets, diversified share portfolios, ETFs, or even a deposit on an investment property. Here is a specific example. Your home is worth $800,000. You currently owe $450,000 on your mortgage. Your equity is $350,000. Most banks will lend up to 80% of the property value. That is $640,000. Minus what you owe, that gives you $190,000 in accessible equity sitting there doing nothing. Take that $190,000 and invest it into a diversified global ETF portfolio, returning a conservative 8% per year. That generates $15,200 per year in investment returns. The line of credit at 6.5% interest costs $12,350 per year. Your net gain before tax is $2,850 in year 1. But here is what actually happens. As the property grows in value, your equity grows. As the ETF portfolio grows, that grows too. In 5 years, you are not earning $2,850 annually. You are earning significantly more because both assets are compounding simultaneously. Most people have one compounding asset working for them, their home. The equity multiplier gives you 2. I need to be completely clear here. This strategy carries real financial risk. If markets fall significantly or interest rates rise sharply, you are still fully responsible for the loan repayment. This is not for everyone. It is specifically for people with stable employment income, existing property equity, a minimum 10-year investment horizon, and a strong stomach for market volatility. Never ever invest borrowed money into speculative assets, single stocks, or cryptocurrency. Only diversified, broad market index funds where the long-term historical return is well established. Please speak to a licensed financial advisor before acting on this strategy. Strategy number 1, and this is the one that surprises people every single time. The one nobody expects to hear on a wealth building channel. The one the top 5% are quietly building right now, while everyone else watches them and wonders how they got so far ahead. The content asset framework. In 2026, creating a YouTube channel, a newsletter, or a podcast is building a real, compounding financial asset. And unlike every other strategy on this list, this one requires zero starting capital. None. Just time and consistency. Here is the framework in its simplest form. Pick one platform where your target audience already spends significant time. YouTube if you prefer video. Substack or a newsletter platform if you prefer writing. A podcast platform if you prefer audio. TikTok or Instagram if you want short-form content. Just pick one, not 3. 1. Create 52 pieces of content in your first year, 1 per week. That is it. Each piece of content you publish stays on that platform for 5 to 10 years, generating views, subscribers, search traffic, and income while you sleep, while you work your day job, while you are on holiday. Here is why this is fundamentally different from every other passive income idea you have ever heard. Content compounds differently from money. A video you create this week in 2026 can still be generating thousands of views in 2032 with zero additional work from you. The asset keeps working indefinitely. The numbers from real creators in 2026, a monetized YouTube channel earns between $3 and $8 per thousand views from advertising revenue alone, depending on your niche. A channel with 100,000 monthly views earns between $300 and $800 per month in completely passive ad income. That is before any other revenue stream. But here is the real money. Ad revenue is the floor, not the ceiling. A finance content creator with 10,000 subscribers reported $1,400 per month from YouTube ads. But in that same year, they earned $38,000 from a single digital product sold to their audience. The content built the trust built the income grew while they created more content. And here is what makes this the #1 strategy on this list. It requires no starting capital, no loan approval, no market conditions going your way, no property equity, no employer, just consistent output over 12 months, one piece per week for 1 year. The reason most people never start is not because they lack ideas. It is because they are waiting to be ready, waiting until the camera is better, waiting until they know enough, waiting until the timing is right. The people building real wealth from content in 2026 are not waiting. They started before they were ready and got better by doing it. 5 strategies, all of them working in 2026. Move your savings to a high-yield account this week. Turn on automatic dividend reinvestment on every position you hold. Increase your retirement contribution by $50 per fortnight starting this pay cycle. If you own property, book a 30-minute call with a mortgage broker to understand exactly what equity you have access to. And if you want to build an asset that earns while you sleep with zero starting capital, open a free account on YouTube or Substack today and publish your first piece this week. The difference between the top 5% and everyone else is not intelligence, it is not income, it is not luck. It is which of these 5 moves they actually made when they first heard about them. Comment below right now. Tell me which of these 5 strategies you are starting first, because next week we are going deep into whichever one gets the most votes from this community. Your comment literally decides what we cover next. And if you are serious about building real wealth in 2026, subscribe. New strategy every single week. No fluff, no theory, just specific moves that actually work. Let us go.